Hey sci-fi team, and welcome back to another episode with Lucas. Today I'll be talking to you guys about 3 great dividend stocks that I've been adding to my portfolio over the years. And I hold these in my portfolio as well, some of my larger positions in my very safe long-term portfolio. We're going to be talking about how to grow financial independence through dividend stocks. All right, so these dividend stocks have great fundamentals. They're great companies. They pay a very healthy dividend. There's also room for appreciation, which means the stock will continue to grow. They're not just going to be a stable stock. And they're still trading at great discounts due to the COVID pandemic. All right. So if you want to get to know which ones those are and get to see my analysis behind them, and I've got a fun little activity for you, make sure to stay tuned throughout the whole video and I'm going to break it down. All right. So this video is for entertainment purposes only and it's sci-fi time. So let's get into this. So first off, I want to talk to you about what exactly is a dividend. All right. So as a investor, essentially you're giving the company money, right? So companies can raise capital through either equity or debt. And debt would be through loans or bonds. And the other way that they raise capital is through equity. So you can buy shares of the company. When you're buying shares of the company, you're essentially buying a little piece of that company. So you are part owner. Right? So as being part owner of it, you also deserve to have part of the earnings that are earned by that company, right? They shouldn't be keeping all that money. They have to pay it out back to us. So every company pays a different dividend amount depending on what their interests are, whether or not they're a high growth company or whether or not they're more of a stable one and they pay out to their investors. So here, we're going to find that happy medium right in between both of them where they are reinvesting in growth. So we are going to see that appreciation, but there's also a very stable and steady income that is going to pay you out. So dividends are great because they pay you whether or not the stock is going up or down. Even during big crashes, for example, the COVID pandemic, dividends are still going to be paid out. And you really want to find those great companies that are going to continue to pay them out and not necessarily cut their dividend or just stop their dividend altogether. All right, so that's essentially what a dividend is. They're giving you a part of the earnings that they generated throughout the quarter, throughout the month, and you as a shareholder deserve a part of that, and that's what a dividend yield is. All right, so let's look at how to calculate a dividend. So essentially the formula to calculate it is you take the dividend, the total dividend payment, the total dividend amount that you'll be making on an annual basis, and you divide it by the stock price. And when you do that division, it gives you the dividend yield, kind of like the interest you would be making in a savings account, right? So that's the calculation on how to solve out for what the dividend yield is, how much interest you'll be making, or what the dividend payment is going to be. Now, another really interesting thing with dividends is that you could set up a DRIP portfolio. So what does a DRIP stand for? It stands for a direct reinvestment plan. And you could contact your broker or do it online, and I highly suggest setting up a DRIP in your account specifically for these dividend paying stocks. So essentially what a DRIP is instead of the company paying you out in cash, they are going to automatically pay you out in shares. So either every quarter or every month, depending on whether the company pays it out quarterly or monthly. Instead of receiving cash, you will be receiving an additional share or 2 shares, depending on how many shares you own. So a DRIP really allows you to compound your growth in that company, for example. And compounding, you will see that in the long run. Over the first year, you might not see the biggest compound, but 10, 15 years down the road is where you will really see your account grow. So essentially, let's take a random example. For example, they pay you quarterly, so they pay you 4 times a year, and you're generating 4 free shares every year by having a DRIP portfolio. Essentially, those 4 shares are commission free, so they don't charge you any commissions on getting those 4 additional free shares, which that's a perk in itself. But over the time being, let's say you start with 100 shares. At the end of the first year, you will be at 104 shares. All right, so now they are going to be paying you dividends on 104 shares. At the end of the second year, you're going to be at 108 shares. And as this continues to grow over the years, well, the amount that they're going to be paying you either quarterly or monthly is also going to be growing because now you have more shares, right? We started at 100, we went to 104. By year 2, we're at 108. By year 3, we'll be at 112. Eventually, you'll be able to start being able to get more than only one share every quarter or month. They'll start paying you out 2 shares because now your dividend payment will be high enough to be able to acquire 2 shares, right? And by doing this, this is how you're going to continue to grow. So by the 3rd year, 4th year, you might be collecting 2 shares every quarter or every month. And additionally, it's going to continue to compound. So by the end of year 10, for example, even though your initial investment was only into 100 shares, by the end of year 10, you may be at 200, 250 shares in your account because it just continues to grow exponentially as your dividend payments continue to grow as well. All right, so I only recommend doing this on good stocks, well stable stocks, good fundamentals behind them, and these are the 3 that I'm going to talk to you about. Of course, there's plenty others, but these 3 are very interesting and they're in fields that are diversified, and not only that, they also kind of correlate with some of the expenses that you and I have on a daily basis. So the first stock that I want to, actually before we get into that first stock, essentially how do we calculate a drip? The drip essentially is what you do is you take the total dividend amount. So you take the total dividend dollar that they are paying you on an annual basis, and you either divide that by 4 if they pay you quarterly, or you divide it by 12 if they pay you monthly. So now you have the dividend payment either on a monthly or quarterly basis. Once you have that dollar amount, you then take the stock price and divide the stock price by that dividend payment. By doing so, you'll know how many shares you need to have in your portfolio in order to be able to acquire a new share every time they pay you out a dividend. All right, so the first stock that I want to take a look at is going to be ticker symbol VZ. That's Verizon. Why do I like them a lot? Well, I've already made a video in the past as them being one of the undervalued stocks and one that has a lot of good growth potential in the future. They've acquired new deals, etc. But if you wanted that video, go into my channel and you can go and find a link towards that. So Verizon overall, they have raised their dividend over the past 15 years. That's definitely something you want to look for when investing in dividend paying stocks. Are they continuously raising their dividend? If not, well, inflation alone is going to eat away at your money, right? Also, by them raising their dividend, it also shows that they have money, that they are earning good revenue in order to be able to keep up with that raising of dividend. So Verizon essentially pays you a $2.51 dividend on a yearly basis. That can also be seen as approximately 63 cents every quarter, so every 3 months. Verizon is one of the corporations that pays quarterly. Most companies do pay quarterly, and a couple of them pay monthly, and I've got one of those monthly dividend paying stocks in store for you as well. That'll be the last one we're going to talk about. So Verizon does pay a quarterly dividend, and their yield is at approximately 4.45%. All right. Their payout ratio is approximately 54.65%. What does a payout ratio mean? Well, a payout ratio essentially means how much is Verizon paying out to the investors who've invested in their company. So Verizon's paying almost 55% of their earnings out to their investors. That's a very healthy amount, meaning that they are keeping approximately 45% in their accounts for themselves. And what does that mean? Well, that 45% goes towards new investments for them, growth, and that's why we're going to see also appreciation in the stock price. So you never really want a company that's paying out almost all their money, all of their earnings in dividends, because that means they have no money left for themselves to be able to grow the company, have new acquisitions, new mergers, etc. So Verizon has a very healthy approximately 54.65, but 55% payout ratio. Definitely something you want to take a look at when looking to add dividends to your portfolio. What is the payout ratio that they offer you? So if we were to set up a drip portfolio with Verizon, essentially what we would do is do that calculation we just talked about at the beginning. So you could take out a paper and pen and solve it out with me right now. Essentially, Verizon is currently at about $56.37. So we would go and divide that by the amount that they are paying you on a quarterly basis, which is just about 63 cents. So when dividing 56.35 by 63 cents, that gives us approximately 90 shares that we need in our account in order to be able to acquire one new share of Verizon every quarter. So by having 90 shares in your account of Verizon, every quarter that Verizon pays out a dividend, you'll be able to acquire one new share. And at the end of the year, you'll have an additional 4 shares in your portfolio for free. One of the little games that I wanted to play with you was to look at what your average expense for your phone bill is on a yearly basis. So let's say the average American pays approximately $50 a month for their phone bill, right? And we're looking at phones because we're investing in Verizon. So if you're paying $50 a month, that means your yearly expense is plus or minus $600, right? So if your expense is $600 for our phone bill, well, it'd be nice to be able to cover that phone bill with one of our investments. So if we need to find $600, how many shares do we need in order for the dividend to cover our phone bill expense? So if we take that $600 expense divided by the yearly dividend they give us, which is $2.51, that gives us a total of 239 shares that we would need in our account to be able to cover that $600 expense. Of course, 239 shares is a larger amount, which equivalates to approximately $13,473. Of course, that's a little bit of a higher amount. If you can't afford to necessarily throw $13,000 down right away onto Verizon, it's still definitely a great opportunity to continuously add to it, and eventually you will find yourself sitting with that amount in your account and be able to pay off your phone bill on a monthly basis just through the dividends that that company pays you. How great is that? Now, the next stock I want to look at is going to be ticker symbol ENB. That's Enbridge. They're both on the Canadian and on the American stock exchange, so you can choose to buy it either or. If you're American, I suggest buying it on the American one. If you're Canadian, I would suggest buying it on the Canadian one. Reasons being just for tax purposes, all right? You will see a fluctuation in price between the two exchanges. Obviously, that is due to the currency difference between the two. So ENB, why do I like ENB? Well, Enbridge, that is one of the biggest oil companies across North America with some of the largest pipelines. All right, they're basically the biggest corporation in this industry. They've been very dominant over the years and have great fundamentals and great growth behind them. They also pay you an exceptional dividend of about 6.75%, which is great to all investors. That dividend is also about $2.76 on a yearly basis, and Enbridge pays you quarterly. So if we were to bring that down to a quarterly basis, that's approximately 69 cents every quarter. I really like Enbridge because they are a dividend aristocrat. What does a dividend aristocrat mean? Well, not only have they been raising their dividend over the past 25 years, they've also been consistent on their payouts. So over the last 25 years, they've been able to pay out a dividend every quarter, which definitely goes to show and represents how strong of a company they've been, being able to survive the 2008 crash, being able to survive this COVID pandemic and everything. They've been consistent on paying everybody what they are due, even though the stock price comes down. That's why I love dividends. So if we were to look at the drip for ENB, well, referring back to the calculations we did before, again, this one we're going to roll through it a little quicker. The stock price for ENB is at approximately $40 a share. So if we take that 40 and divide it by their quarterly payment of 69 cents, 40 divided by 0.69 equals 57 shares. So you would need 57 shares of Enbridge in your portfolio in order to be able to acquire a new share of Enbridge every quarter. Now the last one that I want to look at is going to be ticker symbol, a company called Riocan. They are a real estate REIT For those of you guys who don't know what a real estate REIT is, it stands for Real Estate Investment Trust. So essentially, to be qualified as a REIT, there's certain criteria that they need to do. They need to pay out 90% of their earnings. That also benefits the corporation and the REIT, the trust, for tax purposes as well. But without getting into all of that confusing technical stuff, REITs essentially are owning a little piece of real estate. So if you don't have necessarily 20, 50, 30, any amount of money for a down payment to get into real estate, there's plenty of opportunities in the stock market to step your foot in there and get a little bit and touch a bit of real estate as well by investing in some of these REITs. There are plenty of good REITs out there. The one that I want to focus on is going to be Riocan. The ticker symbol on the Canadian Stock Exchange is REI.UN, and on the American Stock Exchange is RIOCF. All right. So if you're Canadian, I suggest buying it on the Canadian one. If you are American, buying it on the American one. What's very interesting about Riocan is that they pay you on a monthly basis. So unlike Verizon and unlike Enbridge, this one will pay you 12 times a year. Every month they will be paying you out, which also means when we go to set up the drip, instead of only receiving 4 shares a year, you can receive 12. So Riocan currently has approximately a dividend yield of about 4.34%, and on the American Stock Exchange, they pay you about 78 cents a year, or 0.065, so 6 cents a month. And on the Canadian exchange, they pay you about 8 cents a month. Riocan has recently cut back their dividends back in November or December. I believe they cut it by about 30%, which generally is a little bit of a scary thing. You don't want to be invested in a company that is cutting back their dividend. However, Riocan is also a very solid company, and the reason that they cut back on their dividend was really just to preserve capital and be able to remain one of the best REITs that are around. So they haven't cut their dividend because they weren't able to survive. They wanted to preserve capital, reinvest more, and then reinstill their dividend that they were paying out before. So imagine their current dividend of about 4.34% is cut by 30%. So previously it was even higher. All right. Previously on the Canadian exchange, instead of only paying you 8 cents every quarter, they were paying you 12, which would have been $1.44 per year, and now they're only paying you about 90 cents a year. All right. So in order to qualify for a drip in Riocan, you need approximately 275 shares. And what's really cool about them is that you'll be getting 12 free shares on a yearly basis. Now, the last thing that I want to mention is that for these dividend paying stocks, I would recommend having them in a tax sheltered account. Why a tax sheltered account? Well, generally speaking, in a tax sheltered account, you have limited contribution space. So once you put the money in, if you were to lose it on an unsafe stock, on penny stocks, well, you don't get back that space. And in your lifetime, you only have a limited amount of money that you can throw into those tax sheltered accounts. And in order to really take advantage of that, the way that I play these out is I put very safe trades that pay me great dividends, in order to not be taxed on the appreciation and to not be taxed on the dividends. All right. If you are to be putting risky trades in there, well, if you are to lose value or they are to go bankrupt, well, you never get back that contribution space into that tax sheltered account. And of course, none of us want to pay more taxes. So that is my strategy of putting these safe, high yielding dividend stocks in a tax sheltered account. Aside from that, everybody, those are my top 3 stocks in my dividend portfolio that I really love to have. I continue to add to these positions. I have other dividend stocks as well, which I'll make future videos on, but these are 3 dividend stocks in 3 different industries that have really been outperforming everything else, pay a very healthy yield, nothing too scary, and nothing too slim where it's not really attractive, a very healthy yield overall. And not only that, but these 3 dividend stocks are also monthly expenses that you and I both have. Verizon with the telephone bill, Enbridge with the gas and us putting money at the pump for our cars, and real estate to pay off your mortgage, to pay off your taxes on your home, to pay off your rent, whichever it is. These are 3 great stocks that will help you pay off those debts. So aside from that, guys, I hope you enjoyed this video. If you did, please like, share, and smash the subscribe button. Much appreciated from the Sci-Fi team, and we'll see you guys at the next one.